You've heard it 1,000 times. Invest in the stock market. Stay diversified. Ride the ups and downs. Let time do the work. It's the same script every advisor, every retirement planner, and every financial pundit keeps repeating. But here's what they don't tell you. The people who actually build generational wealth, the ones with family offices, legacy portfolios, and the freedom to live their lives on their own terms, don't play by that rule book. They don't rely on 7% index returns. They don't park 90% of their net worth in stocks and bonds and pray for a soft landing. Instead, they move quietly through an entirely different world. The world of private investments, commercial real estate, private equity funds, hedge funds, private credit, alternative investments with better cash flow, superior tax treatment, and zero exposure to Wall Street's volatility.
The stock market. Ugh.
These are the kinds of opportunities that most investors never hear about, not because they're risky, but because they don't generate fees for the institutions that manage your money. But here's the good news. You don't need to be a billionaire or even an insider to access this world anymore. I'm going to show you exactly why the ultra wealthy only allocate about 30% on average of their portfolio to the public markets, how they generate passive income through passive investments that generate real cash flow as opposed to just hoping the S&P rebounds, and how you can start adopting the same strategies that the ultra wealthy use right now, even if you're just getting started in your investing journey. This isn't theory, it's the real playbook behind how wealth is actually built and how the smartest investors protect and scale their capital for decades. And by the end of this video, you won't just understand how the rich invest. You'll know how to get in the game and start investing like the top 0.1% do every single day. For those of you who are new to the channel, my name is Danny Gould. I'm the CEO of Gould Capital, and over the last decade, I've overseen over $250 million worth of real estate transactions, as well as co-managed a $300 million hotel portfolio. And in that time, I've had the privilege of interfacing with some of the wealthiest Americans in the country. And when I discovered that their investment philosophy was so much different than what we've been sold by the Wall Street machine, I decided to start this YouTube channel so that I could share with you the investing secrets of the ultra wealthy. So let's dive into it. Let me start out by asking you a simple question. Now, if the stock market was all it took to build real wealth, why are the wealthiest people in the world barely using it? Why is it that the people with the most capital to deploy, the most access, and the most insight allocate the least to the thing that everyone else is told to rely on? It's not an accident. It's because they know something that most investors don't. Public markets are for wealth preservation, and private markets are where the real wealth is created. So let's just be clear about this, because most retail investors like me and you are taught to play defense. They're told to diversify within the market, pick a blend of stocks, sprinkle in some bonds, add a few ETFs. But the people who actually build generational wealth, they diversify beyond the stock market. They don't just think to diversify their stock tickers. They think to diversify their asset classes. And here is where it all starts to click. You know, everyone loves to quote Warren Buffett. He says to buy the index, hold long term, and be patient. But let's go look at how Warren Buffett actually built his wealth. He didn't buy the S&P 500. He bought entire companies. He bought businesses, negotiated control, took board seats, revamped entire operations. That's not passive investing. That's literally the private equity model at scale. The stock market is where Warren Buffett parks his excess capital after the wealth is already created. And that's the big distinction. The public markets were never designed to create wealth. They were designed and built to preserve it, to offer liquidity, to give retail investors a safe feeling playground. But that's not the playground the ultra wealthy play in to grow their wealth. All right, so where and how do the ultra wealthy actually invest? After interfacing with dozens and studying hundreds of ultra wealthy investors, I've found that they follow what I like to call the asset first approach. The majority of high net worth individuals build a base of predictable cash flowing tax advantaged assets and then layer higher risk, higher upside plays on top of that. Think of it like building a fortress. The foundation is built from real assets that produce real cash flow. Things like real estate, private credit, and debt funds. And then the tower is built with investments that have asymmetric upside returns. Things like private equity, venture capital, and hedge funds. One protects, the other accelerates, and together they compound. That's how you build both durability and growth into a portfolio. Now, I want to make something very clear. This doesn't mean that the wealthy ignore public equities. It means that they don't depend on them. Their portfolios don't live and die with the S&P. Their portfolios are ultimately built around assets that produce real consistent income, shield them from excessive taxation, hold their values across market cycles, and allow for strategic leverage without daily volatility. That's why real estate syndications and funds form the foundation for most ultra high net worth individuals. Not because they're flashy, it's because they're dependable. They're usually structured with preferred returns, they offer depreciation, and they ultimately provide relative relatively reliable cash flow.
It's raining money!
Now that you understand how the wealthiest investors think about asset allocation, let's talk about the asset class that shows up in nearly every serious portfolio, which is private real estate. Real estate is the #1 wealth building vehicle used by the ultra wealthy for a reason. It combines predictable cash flow, long-term appreciation, and powerful tax advantages in a way that few other assets can replicate. But here's the key. These investors, they're not flipping houses. They're not managing tenants, and they're not chasing listings on Zillow or Redfin. They're investing in institutional-grade, income-producing real estate, multifamily, hotels, medical offices, data centers, and they're doing it passively, investing into professionally managed real estate syndications and funds. Now, when you invest in a real estate syndication or a private fund, you're not buying a single rental property. You're pooling capital together with other investors to acquire larger, more profitable assets. Assets that generate income every single month, regardless of what the S&P is doing. So instead of being the landlord, you're the limited partner. You own equity. You collect distributions. And the best part is the day-to-day work is handled by the operator. So why does this matter? Because real estate offers 3 distinct advantages that the public markets simply cannot match. The first being cash flow. These assets are going to produce consistent recurring income that are going to be distributed often quarterly or even monthly. The second is appreciation. Now, we all know that over time, real estate tends to appreciate rather well, especially when you do things like improve the property, manage it professionally to make sure that we're extracting the most amount of profit possible. These are all things that are going to create tremendous value when reselling the property later on. And finally, the third and often most overlooked advantage are the tax efficiencies. This is really where real estate shines. We have depreciation, cost segregation, 1031 exchanges. These are all mechanisms that allow investors to either defer or eliminate taxes altogether. And this is the thing that the ultra wealthy ultimately understand about investments that the average investor doesn't, is that the greatest investment portfolios are the ones that are not only designed to help you grow your wealth, but to also help you protect your wealth via tax-advantaged investments. Now, here's the part that most people get wrong. You don't need $5 million to play in this world. Syndications and funds often accept investors at thresholds as low as $50,000. For accredited investors, that opens up the door to the exact same asset classes that institutions and family offices are using to compound their wealth without taking on the burden of managing the deal yourself. So if you're looking for a way to build stable, inflation-resistant, tax-advantaged income, private real estate is the foundation, not because it's trendy, but because it works. And if you're interested in learning how to access these types of deals, we've put together a free deep dive training that walks through everything: real estate syndications, the fund model, the risks, the upside, and how you can ultimately get started. You'll find the link in the description box down below. Now, real estate is a phenomenal foundation, but for serious portfolio growth, if you want to swing for the fences and not just hit base hits, you're going to need exposure to higher upside, higher risk private investments. And that's where things like private equity and venture capital come in. Now, let's get something straight. The ultra wealthy don't avoid risk. They manage risk. They understand that if you want to capture 10x, 20x, even 100x returns, you have to take swings that public markets simply don't offer. You're not going to find generational returns in index funds. You'll find them in companies before they go public, before they're priced in, before Wall Street even knows that they exist. And that's exactly where private equity and venture capital live. All right, so first off, what is private equity? Because this is a buzzword, and I've covered it on a couple of other videos on this channel, but just to briefly touch on PE and how you can invest into it. Typically, the most common way to invest into private equity is to invest into a fund. And this fund is controlled or managed by a firm that buys businesses. And the businesses are all typically within the same vertical. Think, a bunch of accounting firms, or maybe you've got a bunch of construction companies. The private equity model is simple. Go in, buy the business, improve the business, and sell it for way more than you bought it for. They will typically do that with a lot of companies and then roll them all up together, called a roll-up, and then sell them off at a much higher multiple than what they bought those companies for to begin with. Now, venture capital, on the other hand, is even a little bit more riskier than that. You are typically investing into early stage startups. VC firms provide seed capital and guidance to early stage startups in exchange for equity. Now, VC is very high risk. Not every company succeeds, but when you pick right or partner with a group that knows how to underwrite and pick correctly, you don't need to have a high batting average. One win can easily carry the entire portfolio. And that's how the ultra wealthy think. They're not chasing safety. In this case, they're positioning for asymmetric asymmetric upside. Now, you've obviously heard the phrase swing for the fences. Well, this is exactly what that actually looks like. For home runs and grand slams, you can't just play it safe. You need positions in companies or funds that have a real shot at outpacing the market, not by 2%, but by 10x. The ultra wealthy don't build legacies on index funds. They build them through equity. And of course, these deals come with risk, but they also come with outsized upside. And that's the kind of risk that the wealthy are willing to take because it's calculated, not reckless. So now we've covered both sides of the asset first approach, starting with the foundation in cash flowing asset-backed investments, and then ultimately the towers that those foundations are built on with high-risk asymmetric swing for the fences rewards. At the end of the day, this isn't rocket science. It's just a very clear and disciplined framework. And if you want to start building wealth like the ultra wealthy do, without being a billionaire or a private equity insider, there's a simple 5-step process that you can use to start investing like the ultra wealthy. Step 1 is to educate yourself. The ultra wealthy never invest in things that they don't understand. And guess what? The reality is these guys are super smart and they do their homework, and you should be doing the same thing. You have to know the game before you play it. Step 2 is build the right relationships. The ultra wealthy understand that the most important part of all of this is actually access. Networking, getting in the right rooms with people, and ultimately partnering with the right operators is imperative for success. Now, I'd be remiss if I didn't shamelessly plug myself right now. Gould Capital is a fund of funds that invests into these types of opportunities: commercial real estate, hotel deals, multifamily, as well as other alternative investments. Now, if you're curious what it would look like to join our investor network, access is free, but it is exclusive. If you don't make $200,000 per year or have at least a net worth of $1 million, I'm sorry, but we probably wouldn't be the right fit for you at this time. But if that does apply to you and you are either making $200,000 or more a year or have a net worth of over $1 million, you can find the link to my calendar in the description box down below. I'd be happy to have a conversation with you and see if we'd be a good fit to partner with one another. Now that brings us to step 3, which is choosing your focus. Ultimately, every investor needs to have a few silos, a few asset classes that they're educated on and feel like they are knowledgeable enough and connected enough to invest into. For foundational type stuff, if private credit sounds more interesting to you than real estate syndications, well, go study and get educated on that. And for upside, if hedge funds sound awesome and you'd rather invest into hedge funds than private equity or venture capital, then that's great. Find a few silos that you can really focus on and go deep. Step 4 is start reviewing deals. The more deals, the more sponsors that you get in touch with, the more deal packets that you receive and you can actually pen through, just going to sharpen your skills and make you that much more confident as an investor. Ultimately, that confidence will allow you to invest with conviction. And speaking of conviction, then we have step 5, which is actually writing the first check. The first check is always the hardest one. That's what every investor says, especially when they're entering a new asset class or, investing into any type of alternative investment for the first time. First time that you cut a check outside of just, wiring money to your financial advisor, it is a big step. And so writing that first check, while it is the hardest part, once you get there, then it becomes a lot easier. It's a snowball effect. So the first check is the hardest one. So don't be afraid to cut the first check, but also don't give away the entire farm on the first check. This is one thing that they get really excited about a deal because it looks great on paper, but guess what? It's not going to be the last deal. And so you got to be very careful. Make sure that you're not giving away the full farm. Just put a little bit, just put a few in there, a few shekels that you would not mind losing if shit hits the fan and you, for whatever reason, lose on that investment. That's the first one, so you might not hit a home run on that one. So be careful, but don't be hesitant to get in the game. The truth is simple. The stock market is not the only way to build wealth. In fact, it's not even the way that most wealth gets built anymore. The ultra wealthy have known this for decades, and they've used private markets, real estate, private equity, venture capital, hedge funds, not just to grow their portfolios, but to control them, protect them, and to scale them in ways that the public markets never could. And now you have a choice. You can keep doing what most people do, hoping the market rebounds, checking charts, settling for the average, or you can step into a smarter model, one that's built around access, control, cash flow, and true diversification. The choice is yours, everybody. And if you've made it this far in the video and you're not yet subscribed to this channel, what are you waiting for? Click the subscribe button, hit the notification bell to get notified every single time I post a new video just like this one. This is Danny Gould, everyone, with Gould Capital. Hope you enjoyed these investing secrets. Catch you all in the next video.